When we typically consider investing, most of us picture numbers, charts, economic news. It's all so external, isn't it? We often imagine successful investors as these cool calculating machines, sort of impervious to emotion. But what if the single biggest factor isn't out there in the market or hidden in some complex analyst's report, but something, well, far more personal right here in your own head?
It's a striking point, actually. Despite the mountains of quantitative analysis and sophisticated models, human psychology is consistently overlooked. Yet it's arguably the most critical component impacting investment outcomes. It's what so frequently leads us to make, well, illogical decisions and achieve less than ideal results.
And that's exactly the deep dive we're embarking on today. We're venturing into the absolutely fascinating world of investment psychology, and we're drawing powerful insights from Pankaj Shetty's eye-opening book, Conquering the Market: Mastering Investment Psychology.
Yeah, and our mission today is basically to equip you with a genuine shortcut, a way to understand the powerful emotions and sneaky biases that influence every single investment decision you make. It's really about empowering you to make truly rational choices and achieve that long-term financial success, not just by understanding market mechanics, but by, mastering your own mind.
It's wild how often this fundamental truth gets sidelined. Sethi argues right from the start that human psychology, though frequently disregarded, is the most important component. It impacts investment outcomes, leading to so many illogical, costly decisions. So where does he suggest we begin this journey of self-discovery in our financial lives?
Sethi begins by taking us straight into what he calls the emotional roller coaster of investing. And at its core, he identifies two primal, dual forces that really define investor behavior: fear and greed.
Okay, let's start with fear. That sounds like a pretty straightforward emotion, but how does Sethi describe its manifestation? How does it show up in the investment world?
Well, fear, particularly the fear of loss, isn't just paralyzing, it's a cunning saboteur. Sethi argues it's not merely about avoiding necessary risks, but actively forcing us to liquidate assets at precisely the worst possible time. Think about the panic selling during the 2008 financial crisis, for instance. Countless investors gripped by fear sold their holdings at rock-bottom prices, locking in losses that, well, would have recovered had they simply held on. The real insight here is recognizing that this fear often masquerades as prudence, which makes it incredibly hard to overcome.
Yeah, I remember that vividly, that feeling of collective panic. It's like everyone suddenly decides to jump off the ship at the same time. And there's also something called analysis paralysis, isn't there? Where the fear of making the wrong decision means you don't make any decision at all.
Precisely. And that indecision, that inaction, it prevents investors from taking advantage of opportunities or even effectively protecting themselves sometimes. Sethi highlights it as a significant barrier because it leaves capital just sitting there, stagnant, and opportunities unseized.
Okay, so if fear is one side of this powerful coin, greed must be the other. How does greed, that desire for quick profits, tend to mess with our investments?
Greed, oh boy. Driven by the seductive promise of quick profits, it can inflate an investor's ego, leading to arrogance and, frankly, utterly reckless actions. It encourages us to disregard critical warning signs and take unwarranted risks. A prime example, the dot-com bubble of the late 1990s. So many investors, fueled by unbridled greed, bought massively overpriced stocks without any real consideration for underlying fundamentals. The inevitable market crash led to staggering losses for those who chased those trends, blinded by the potential for overnight riches.
I can sort of relate to that feeling. It's like when you have a couple of successful trades and you just get this rush right, suddenly you feel invincible and start overtrading, completely ignoring your own risk management rules you set up.
That's a classic trap, definitely. The thrill of a successful trade can lead to excessive activity, and that not only increases your transaction costs, but also exposes you to far greater, often unnecessary risk. Sethi is clear that both fear and greed thrive on unchecked emotion.
So these forces, fear and greed, they sound almost insurmountable when you put it like that. But Sethi offers strategies to mitigate them, right? What's the core philosophy he suggests for regaining control?
Absolutely, he does. The core is really cultivating emotional intelligence. It's not about eradicating fear or greed, because let's face it, those are natural human emotions. Instead, it's about recognizing them, understanding their triggers, and then having predefined mechanisms ready to counteract their influence. For instance, Sethi advocates for practical steps like presetting stop-loss orders so your emotions can't override a rational exit strategy. But it's also about managing your expectations. Are you truly aiming for realistic, sustainable growth? Or are you secretly chasing that quick, greedy win that often leads to disaster?
Right, managing expectations. Okay, so beyond fear and greed, Sethi highlights a much deeper and more complex emotional landscape that significantly impacts investment decisions. What other emotions are we up against in our own heads?
Well, there's hope, for instance. While it can certainly fuel resilience and help us stay optimistic, which is good, excessive hope is a dangerous double-edged sword in investing. An investor might hold on to a continuously declining stock, hoping against all rational evidence for a rebound, even as the losses mount. This can lead to holding fundamentally underperforming positions for far too long, ignoring clear market signals, delaying crucial decisions, and ultimately leading to even greater financial losses.
So hope can actually be detrimental if it blinds us to reality.
Mm.
What specific strategies does Sethi offer to harness hope positively without, falling into its pitfalls?
To manage hope effectively, Sethi advises setting extremely realistic expectations for every single investment. Develop a solid, data-driven investment plan that guides your decisions, rather than relying on wishful thinking. Regularly monitor your investments with an objective eye, and be prepared to cut your losses when an investment consistently isn't performing as expected. The key is not to let unfounded hope cloud your judgment.
Okay, that makes sense. And then there's regret, that agonizing feeling of, oh, I should have bought that stock, or why didn't I sell sooner? How does that emotion play out on our portfolios?
Oh, regret can be a powerful driver of impulsive decisions. It often shows up as FOMO, the fear of missing out. You end up chasing past performance, buying into assets purely because you missed their initial surge. It also fuels hindsight bias, where you think, oh, I knew that was going to happen. An investor might deeply regret not buying a stock that recently surged, and then impulsively buy a similar one without proper analysis, just to avoid feeling that same regret again.
It's interesting how closely that links back to the idea of anchoring we just discussed, letting that initial price or past performance cloud your judgment. So what does Sethi suggest we do about regret? How do we mitigate its impact and move forward constructively?
To mitigate regret, Sethi stresses the importance of accepting imperfection. Look, no investor makes perfect decisions all the time, and that's okay. Instead of dwelling on the past, focus on the future and what you can control now. Developing a robust investment plan can significantly reduce impulsive decisions driven by regret. Mindfulness practices can help you observe these feelings without acting on them, and, don't hesitate to seek professional advice for objective guidance that removes personal bias.
Next up is overconfidence. I can definitely see how that would be a problem. You make a few good calls and suddenly you think you're the next Warren Buffett, destined to perfectly time the market.
Exactly. Overconfidence is a dangerous trait because it leads investors to consistently overestimate their own abilities. This results in excessive risk-taking, a tendency to ignore sound expert advice, and trading far too frequently, which racks up significant transaction costs. An overconfident investor might genuinely believe they can perfectly time the market, buying at the absolute bottom and selling at the peak. This usually leads to significant and often unavoidable losses as the market inevitably moves unpredictably.
That's a classic pitfall for sure. How do we keep our confidence in check, ensuring it serves us positively without leading to recklessness?
Sethi emphasizes recognizing your limitations. No one, not even the most seasoned professional, can perfectly predict the market's every move. Actively seek diverse perspectives. Deliberately expose yourself to viewpoints that might challenge your own assumptions. Utilize protective measures like stop-loss orders to automatically limit downside. Crucially, maintain a long-term perspective. It's the best antidote to the temptation of trying to perfectly time the market. And a practical tip: keep a journal of your trades. Review your past performance honestly and identify where biases might have influenced your decisions.
Okay, and then there's anxiety. The market is inherently uncertain and volatile, so this one feels almost inevitable for many investors, right? How does anxiety specifically impact investment decisions?
It is pretty common, yeah. Market uncertainty and volatility are huge triggers for anxiety, and when left unchecked, it leads to hasty and often deeply irrational decisions, like panic selling or overtrading. During a significant market correction, an anxious investor might panic sell their entire holdings, locking in losses that could have recovered. And this action itself can then fuel further anxiety in a negative feedback loop.
So beyond just acknowledging it, what tangible strategies can we use to manage anxiety and make rational decisions even when the market is throwing curveballs?
Sethi recommends mindfulness techniques like meditation or even just focused deep breathing exercises. They help calm the mind and create a pause before acting. Developing a solid, predefined investment plan provides a sense of security and a clear roadmap, reducing the need for impulsive reactions. Diversifying your portfolio naturally reduces risk concentration, which can lessen anxiety. Using stop-loss orders can protect against significant losses. And perhaps most importantly, consciously commit to making decisions based on facts and thorough analysis, not raw emotion.
What about excitement? We usually
Uh,
think of that as a positive emotion, but Sethi points out it can actually be a pitfall in investing. How does that happen?
yeah, it's interesting. While excitement can indeed be a powerful positive motivator, excessive excitement, especially from a series of successful trades, can quickly morph into overconfidence, and that leads to overtrading and taking on unnecessary risks. After a string of profitable trades, an investor might become overly elated and start taking on significantly larger positions or investing in much riskier assets, dramatically increasing their risk exposure without a corresponding increase in due diligence.
So how do we channel that positive energy without letting it turn into recklessness? How do we keep a level head when things are going well?
Sethi's advice is to set clear, specific investment goals and critically stick to them regardless of short-term wins. Practice patience and consciously avoid impulsive decisions driven by feeling like you have a hot hand. Continue to use stop-loss orders and maintain a diversified portfolio as your defensive line. Another practical tip: taking regular scheduled breaks from the markets helps prevent emotional decision-making driven by constant real-time feedback.
Finally, there's despair. This feels like the absolute lowest point on the emotional roller coaster, a truly devastating feeling for an investor.
It truly is. Prolonged losses or a significant market downturn can indeed lead to profound feelings of despair and hopelessness. This state can cause investors to completely lose faith in their strategies, their research, and even their own judgment. It often results in impulsive, self-destructive decisions, like selling an entire portfolio at a significant loss. This can completely devastate long-term financial goals and lead to a deep loss of confidence and, in extreme cases, withdrawal from the market entirely, missing future recovery opportunities.
That's a tough one to navigate. When you're in the depths of despair in your investment journey, what does Sethi advise to help you climb out?
First, Sethi emphasizes acknowledging the situation and allowing yourself to feel the negative emotions, but crucially, not letting them control you. He suggests taking a temporary break from the market to clear your head and gain perspective. Use that time to reassess your investment strategy objectively. Crucially, seek support. Talk to trusted friends, mentors, or financial advisors who can provide an objective viewpoint. And remember Sethi's core message: focus on the long term. Remind yourself that market downturns are temporary, part of the natural cycle. Mindfulness can also be a powerful tool here, helping you stay calm and focused during these profoundly challenging times.
It's fascinating how, even if you feel you've conquered your emotions, there are still these hidden traps in our thinking, these systemic errors. Sethi calls them cognitive biases. What exactly are these, and why are they so dangerous?
Right. Cognitive biases are basically systematic errors in thinking that consistently lead to irrational investment decisions. They're often unconscious, deeply ingrained mental shortcuts. And because we're usually unaware of their influence, they significantly impact investment outcomes, often without us even realizing it. They're like glitches in our mental operating system, you could say.
Let's unpack some of the key ones Sethi highlights. First, confirmation bias.
Confirmation bias is fascinating because it's like a mental filter. Sethi explains it as our brain's tendency to actively seek out information that validates what we already believe, while conveniently ignoring anything that challenges it. So if you're convinced the stock is going to soar, you'll subconsciously zero in on every positive news article, analyst report, or social media post that supports your view, and completely disregard any red flags or contradictory evidence. It's not just selective listening, it's selective seeking.
And loss aversion. That one sounds pretty intuitive, like we just hate losing.
It is intuitive, but it's more powerful than simple dislike. Loss aversion describes the profound psychological impact of feeling the pain of losses far more intensely, like twice as intensely, than the pleasure of equivalent gains. Sethi explains this leads to a powerful reluctance to sell losing positions. An investor might cling to a losing stock, hoping it will recover, simply to avoid realizing that painful loss, even if holding on to it means incurring further, deeper losses. The emotional cost of accepting a loss is just too much for many people to bear.
What about anchoring? I've definitely heard that term outside of finance, but how does it manifest in investing?
Anchoring is when you over-rely on the very first piece of information encountered. You effectively anchor your judgment to it, even when new, more relevant information becomes available. For example, an investor might value a stock based solely on its initial purchase price, or maybe a historical high they remember. They completely ignore fundamental changes in the company, the industry, or the broader market that have occurred since that initial data point. That first price becomes an emotional anchor, dragging down rational judgment.
Then there's the sunk cost fallacy. That one sounds like throwing good money after bad just because you've already invested something.
Precisely. The sunk cost fallacy is the irrational tendency to continue investing time, money, or effort in a losing endeavor simply because of past investments you've already made. Sethi illustrates this as, say, continuing to fund a failing business or hold a plummeting stock, hoping to recoup your initial investment. Even when all objective analysis indicates the endeavor is no longer viable, it's the psychological trap of not wanting to waste what you've already committed, even if committing more is the waste.
And finally, recency bias. That feels very relevant in our 24/7 news cycle world where we're constantly bombarded with the latest information.
Definitely. Recency bias means you systematically overweight recent events and underweight historical data, leading to a strong short-term focus. An investor influenced by this bias might overreact to the latest market news, a good earnings report, a geopolitical tremor, and make buying or selling decisions based solely on these immediate trends, rather than adhering to a long-term, well-researched strategy that considers broader historical context. It makes us think the very recent past is the most important predictor of the future, which is often not true.
So these biases are deeply ingrained, almost invisible traps. What does Sethi suggest as the most effective strategies to mitigate their sneaky influence?
To effectively mitigate these pervasive biases, Sethi's primary advice is to actively seek diverse perspectives. Deliberately expose yourself to information that challenges your existing beliefs. Practice critical thinking by constantly questioning your own assumptions and the narratives you encounter. He emphasizes relying on data-driven decision-making, not just intuition or gut feelings. Practical tools like using stop-loss orders can help protect your investments from emotional decisions influenced by bias. And regular, disciplined portfolio reviews allow for objective adjustments, helping to counteract biases before they cause significant damage.
This all really boils down to mastering your mind, doesn't it? Sethi makes it abundantly clear that emotional intelligence isn't just some soft skill, it's absolutely crucial for successful long-term investing.
It's the absolute foundation, really. By truly understanding and effectively managing your emotions and recognizing your biases, you can consistently make more rational, objective decisions and avoid the common costly mistakes that plague so many investors. This is fundamentally key for achieving long-term financial health and stability.
So what are the key components, the core skills Sethi identifies in developing this kind of powerful emotional intelligence specifically for investing?
Okay, first he highlights self-awareness. This means the deep ability to identify your own emotions as they arise, truly understand your inherent biases, and track your emotional patterns, maybe through consistent journaling, for example. Second, self-regulation. This is the skill of managing your emotions and impulses, like consciously resisting impulsive decisions through practiced patience and mindfulness, giving yourself that critical pause before acting. And third is motivation, fueling your drive by setting clear, specific, measurable, achievable, relevant, and time-bound, what we often call SMART goals. This provides a compelling why for your investment discipline.
SMART goals are a great framework, yeah. And what about relating to others in this journey? Investing can feel solitary, but it's also connected to a broader ecosystem, isn't it?
That's where empathy comes in, the ability to understand others' perspectives. This means actively listening, thoughtfully considering different viewpoints, and recognizing the emotions driving others, whether it's understanding a financial advisor's reasoning or maybe a friend's market anxiety. Finally, social skills. Building supportive relationships with other investors, mentors, and advisors through networking, effective communication, and fostering genuine trust. These connections can offer valuable outside perspectives when your own emotions are running high or your biases are kicking in.
Beyond just understanding these skills, the book provides some truly practical techniques for emotional mastery that anyone can start implementing. Where does Sethi suggest we begin with these techniques?
Mindfulness and meditation are powerful starting points. By training yourself to pay attention to the present moment without judgment, you can effectively calm your mind, significantly reduce stress, and enhance your overall emotional regulation. This creates the mental space needed to make more rational, less reactive investment decisions, like, taking a deep breath during a market downturn instead of instinctively hitting the sell button.
So giving yourself that crucial pause, what else can we do to build this self-awareness he talks about?
Journaling and reflection are a profound path to self-awareness and continuous growth. By regularly writing about your emotions, your investment decisions, and their outcomes, you can objectively identify recurring patterns, understand the triggers for certain emotional responses, and process stressful trading days to learn from them. It's like building a personal investment psychology database over time.
That's a great way to look back and see what was really going on behind your decisions. And then there's visualization and affirmations. How do these mental exercises apply to investing? They sound a bit out there.
Well, they can be very practical, actually. These are about consciously shaping your reality and reinforcing positive beliefs. Visualization involves creating vivid mental images of your desired financial outcomes, like seeing yourself achieving financial independence, reaching a specific savings goal, or living in your dream home thanks to your smart investments. It makes the goal more tangible. Affirmations are positive statements you repeat to yourself, such as, "I am a disciplined investor," or "I make rational financial decisions." They're designed to reprogram your subconscious mind and boost self-confidence and conviction over time.
Sounds like a powerful mental game, preparing your mind for success. What about reframing those inevitable negative thoughts that creep in during difficult market times?
That's where cognitive behavioral therapy, or CBT, techniques prove incredibly valuable. This involves a systematic process. First, identify irrational or negative thoughts, then actively challenge them with evidence, and finally, replace those irrational beliefs with more realistic and constructive ones. For example, if you catch yourself thinking, "I'm a terrible investor," after a loss, CBT helps you reframe that. You focus on the specific lessons learned from the experience and how you'll apply them to future opportunities. It's about learning, not labeling yourself.
And sometimes, despite our best efforts, we just need a guiding hand. When does Sethi suggest an investor should consider seeking professional help for their financial journey?
Yeah, knowing when to ask for help is key. Seeking professional help is a wise and strategic investment when you're struggling with overwhelming emotions like persistent fear or crippling anxiety, or maybe dealing with complex financial situations that are beyond your current knowledge, or experiencing decision paralysis due to a lack of clear direction. A qualified financial advisor can provide an objective perspective, offer expert advice tailored to your situation, and significantly reduce your emotional stress by helping you navigate challenging periods with clarity and a plan. It's about getting an unbiased second opinion when your own mind is cloudy.
Ultimately, Sethi stresses that investing is a marathon, not a sprint. Long-term financial success, he argues, requires disciplined adherence to a well-thought-out investment plan, even and maybe especially during the inevitable challenges. So how do we begin this disciplined approach? Where is the starting line?
It fundamentally starts with setting realistic, well-defined goals. This means distinguishing clearly between your short-term goals like building an emergency fund or saving for a down payment on a home, and your long-term goals, such as retirement planning, funding a child's education, or significant wealth accumulation. Sethi emphasizes that vague goals lead to vague, undisciplined investing. You need something concrete to aim for.
So it's not just about dreaming big, but about making those dreams concrete and actionable. How does Sethi advise creating a personalized investment plan that truly acts as this indispensable roadmap?
A personalized investment plan, according to Sethi, should be comprehensive. It must define clear, specific, and measurable financial goals, like we just said. Crucially, it involves a thorough assessment of your personal risk tolerance. How much fluctuation can you really handle? The plan should then guide you in diversifying your portfolio across various asset classes to manage risk effectively. It also includes setting a realistic budget for how much you can invest regularly and establishing a schedule for monitoring and adjusting your plan as your life situation or market conditions inevitably change. It's a living document, not set in stone.
And the realistic expectations part is absolutely key here, isn't it? It's so easy to get swept up in the latest financial headlines promising, crazy returns.
Absolutely. Sethi stresses that you must acknowledge inherent market volatility and avoid expecting to double your investment overnight. That's just not how it usually works. Understanding your own risk tolerance, what level of fluctuation you can truly stomach without panicking, and cultivating profound patience are vital. He also warns against the common trap of comparing your financial journey to others. Everyone's path, risk profile, and goals are unique. Unrealistic expectations are just a breeding ground for disappointment and impulsive, fear-driven decisions.
Speaking of risk, managing it is a huge part of being disciplined. What are the core strategies Sethi highlights for protecting your capital and minimizing downside?
Okay, first, understanding your risk tolerance is paramount. This means knowing your personal limits based on your age, your financial situation, the time horizon for your goals, and even your personality. Are you naturally cautious or more aggressive? Then diversification is non-negotiable. Spreading risk across various asset classes like stocks, bonds, cash, real estate, maybe even commodities. But Sethi adds that true diversification extends to geographic regions and different market sectors, too. It's not just about scattering your money randomly, it's a strategic shield against concentration risk. Ensuring a downturn in one area doesn't devastate your entire portfolio.
So don't put all your eggs in one basket, but do it strategically. What about limiting losses once you've already invested in something?
That's where stop-loss orders come in as a powerful risk management tool. These are automated orders to sell a security when it reaches a predetermined price, thereby limiting your potential losses before they get too big. Sethi explains the difference between simple stop-loss orders and trailing stop-loss orders, which adjust upwards as the stock price moves in your favor, helping to protect accumulated profits while letting winners run a bit. They act as an unemotional preset exit strategy. Takes the panic out of it.
And position sizing. That sounds like a technical term, but Sethi really emphasizes its power. How does it work practically?
It sounds technical, but it's fundamentally about risk control and capital preservation. Instead of just picking a stock you like, you're intentionally deciding how much of your total capital to allocate to that specific security or trade. It's based on your risk tolerance, the overall size of your account, and the inherent volatility of the asset itself. More volatile stock, maybe a smaller position. Sethi highlights it as a proactive defense mechanism. If you're a conservative investor, you might only commit, say, 1% or 2% of your portfolio to a single trade. That means even a significant loss on that one position won't decimate your overall capital. It's about protecting your base, not just chasing outside gains on every single trade.
Even with all these meticulous strategies, obstacles will inevitably come up. How do we stay disciplined when the market throws us a curveball or when our emotions start to take over again?
The critical obstacle Sethi warns us to overcome is overtrading. Trading too frequently not only increases transaction costs, which definitely erode returns, but more importantly, it often leads to emotional decisions made in the heat of the moment, ultimately reducing overall returns. Strategies to avoid it include having that solid, predefined investment plan, setting realistic expectations, cultivating deep patience, and adhering to a disciplined approach with limited strategic trading frequency. Don't just trade because you're bored or excited.
And market volatility itself can feel like a storm we just have to weather. How does Sethi advise navigating that turbulence?
First, you need to understand its drivers, things like economic indicators, geopolitical events, corporate earnings reports, and shifts in overall investor sentiment. Knowing why things are moving helps. Strategies include continued diversification and regularly rebalancing your portfolio back to your target allocations. This forces you to buy low and sell high systematically. He strongly advocates for dollar-cost averaging, where you invest a fixed amount regularly, regardless of market conditions. It smooths out your purchase price over time. Crucially, maintaining emotional control and steadfastly sticking to your long-term plan is absolutely essential. Don't let the short-term noise derail your long-term vision.
So patience truly is a virtue in this realm, isn't it?
It's absolutely vital. Patience allows for a long-term perspective that filters out the daily noise, significantly reduces emotional trading, and consistently leads to improved decision-making. Investors who embody patience often use strategies like dollar-cost averaging or value investing, patiently waiting for undervalued stocks to appreciate over time rather than chasing quick, often fleeting gains.
And finally, we all make mistakes. It's inevitable in investing. How does Sethi suggest we learn from them effectively, rather than being paralyzed or discouraged by them?
Right, mistakes happen. First, acknowledge them openly and take full responsibility. Don't blame the market or bad luck entirely. Then, critically analyze them to identify the root cause. Was it a specific bias we talked about? A lack of research? Emotional reactivity like fear or greed? Sethi also emphasizes learning from others' mistakes. Study market history. Read about the experiences of seasoned investors, both their successes and their failures. There are tons of lessons there. And developing a growth mindset is absolutely key. View setbacks not as proof of failure, but as opportunities to learn, adapt, and grow stronger as an investor. It's about continuous improvement.
It's always incredibly insightful to learn from the successes and failures of those who've walked the path before us. Sethi gives us some compelling real-world examples. Let's start with the big names, the undisputed masters of the investment game.
Yeah, what's fascinating here is how these legends truly embody the psychological principles we've been discussing all along. Take Warren Buffett, the Oracle of Omaha. His philosophy revolves around deep value investing, finding undervalued businesses with strong fundamentals. Psychologically, this demands immense patience and a disciplined resistance to market fads and noise. He emphasizes a long-term perspective, buying and holding for decades. Sticking strictly within his circle of competence, investing only in businesses he profoundly understands, which guards against overconfidence, and always seeking a margin of safety to protect against downside risk. That's a powerful antidote to fear right there.
So profound understanding and an almost Zen-like patience seem to be his hallmarks. What about Peter Lynch? He had a different, maybe more approachable philosophy, didn't he?
Indeed. Peter Lynch, known for his stellar record at Fidelity Magellan, famously said, "Invest in what you know." He looked for undervalued growth stocks, often found in familiar industries, things you might encounter in your daily life. This combats confirmation bias by encouraging personal research rather than simply following the crowd or hot tips. He also believed strongly in diversification, spreading risk, and emphasized doing your own thorough research again to prevent emotional buying of overhyped stocks without understanding them.
And from India, Rakesh Chanchanwala, often called the Big Bull. What can we learn from his approach through a psychological lens?
Chinchilla, much like Buffett actually, exhibited a profound long-term perspective, focusing on quality businesses with strong fundamentals and management. Psychologically, he practiced contrarian investing. He often went against the crowd to find undervalued gems when others were fearful or pessimistic. This required immense self-regulation and a disciplined resistance to herding behavior. His disciplined approach, even during severe market downturns, is a real testament to mastering despair and anxiety.
Beyond these titans, are there any other notable investors whose insights reinforce these psychological principles we've explored today?
Oh, absolutely. Benjamin Graham, Buffett's mentor and the father of value investing, emphasized the critical concept of the margin of safety, which is a direct counter to overconfidence and paying too much. Charlie Munger, Buffett's longtime partner, championed the use of diverse mental models from different disciplines, encouraging a broader, less biased perspective when analyzing investments. Philip Fisher focused on growth investing, but crucially, also on the quality of management, really understanding the human element driving the company. And John Bogle, the Vanguard founder, pioneered low-cost index fund investing. He stressed the psychological virtues of patience, minimizing fees, which removes the temptation of active trading, and just staying the course. The key takeaways from all of them: consistently a long-term perspective, a disciplined approach, robust risk management, continuous learning, and crucially profound emotional control.
Learning from mistakes is just as vital as learning from successes, as you said. Sethi delves into some powerful failure stories, particularly from major market crashes. What are the big psychological lessons from events like the dot-com bubble, the 2008 financial crisis, or even the more recent COVID-19 pandemic crash?
Right, these crashes offer stark, painful lessons, primarily rooted in human psychology getting the better of people collectively. The dot-com bubble, for instance, taught us to ruthlessly avoid overvalued stocks driven by unrealistic expectations and sheer greed. Thorough research and objective valuation are paramount, countering recency bias, this time it's different, and herd mentality. The 2008 financial crisis underscored the absolute necessity of diversification and robust risk management. Spreading exposure helps prevent panic selling rooted in overwhelming fear when one sector collapses. And the sudden COVID-19 pandemic market crash really emphasized the critical importance of having a long-term investment horizon. Avoiding impulsive panic selling during extreme downturns requires maintaining emotional control. Each of these events amplify the very biases and emotions Sethi warns us about.
So it really comes back to the emotional control we talked about right at the beginning. What about common, everyday investor mistakes that people make, not just during crashes, but repeatedly, chipping away at their returns?
Oh, there's a long, unfortunately common list. Overconfidence, as we discussed, consistently leads to excessive risk-taking and poor diversification. Fear and greed cause impulsive panic selling at bottoms or irrational chasing of returns at tops. Herding behavior leads people to blindly follow the crowd without their own independent research, amplifying market bubbles and crashes. It feels safe, but it's often dangerous. Anchoring bias means relying too heavily on past prices, like your purchase price, ignoring current fundamentals. Confirmation bias causes you to only seek information that supports your existing beliefs, creating a dangerous echo chamber and blinding you to risks. Then there's home bias, where people overinvest in their own country's stocks, severely limiting diversification and exposure to global growth opportunities.
And the practical, maybe less dramatic, everyday mistakes that still really chip away at returns over time.
Absolutely. Overtrading directly leads to increased costs, commissions, taxes, and emotional decisions, significantly reducing net returns. Just doing something isn't always better than doing nothing. Ignoring fees erodes long-term wealth, often subtly but significantly over decades. Those small percentages add up. Chasing performance frequently means buying assets after they've already had their big run, essentially buying high just as they might be peaking. Not rebalancing your portfolio periodically leads to asset allocation drift. Your intended risk profile changes without your conscious decision as some assets outperform others. And ignoring taxes, understanding the tax implications of your investment decisions can significantly reduce your actual net returns, often catching investors by surprise later on. By being acutely aware of these common psychological pitfalls and taking proactive, disciplined measures like the ones Sathi outlines, you can significantly improve your investment outcomes. You can truly conquer the market, not just with numbers, but with your mind.
As you reflect on your own financial journey, what is one hidden emotional trigger or cognitive bias you're now curious to uncover in yourself? And how might that understanding fundamentally change your next investment decision?